Question 1. Policy provisions and features. Which of the following would likely be considered a valid benefit trigger for a long-term care insurance etc. policy to start paying benefits? A. The insured has been diagnosed with a chronic illness but is still able to perform all activities of daily living adults. B. The insured is unable to perform 2 out of 6 adults, such as bathing and dressing. C. The insured is diagnosed with a short-term injury such as a broken arm. D. The insured voluntarily chooses to move into an assisted living facility even though they are fully capable of living independently. Answer. B. The insured is unable to perform 2 out of 6 adults, such as bathing and dressing. Explanation. The majority of LTCI policies require the insured to be unable to perform at least 2 out of 6 activities of daily living adults to trigger the policy benefits. These 8 DLS generally include activities like eating, bathing, dressing, toileting, transferring, and continence. Being diagnosed with a chronic illness alone, option A, is not enough to trigger benefits if the insured can still perform the required adults. Short-term injuries, option C, usually do not qualify because LTCI is meant for long-term care, not acute or temporary conditions. Voluntarily moving into an assisted living facility, option D, without a qualifying medical condition will also not trigger benefits, as the purpose of LTCI is to provide care when individuals can no longer care for themselves. Youth will follow us the Health Insurance Portability and Accountability Act HIPAA guidelines, which define these benefit triggers, and most LTCI policies sold in the state adhere to these standards. Question 2. Consumer considerations. When advising a client on the cost of a long-term care insurance LTCI policy, which of the following factors would most likely result in a higher premium? A. The client selects a policy with a longer elimination period. B. The client is young and in excellent health at the time of purchase. C. The client selects a policy with comprehensive inflation protection. D. The client chooses a daily benefit amount lower than the average cost of care in their area. Answer. C. The client selects a policy with comprehensive inflation protection. Explanation. Choosing comprehensive inflation protection, option C, typically leads to higher premiums. This protection adjusts the policy's benefits over time to keep pace with the rising cost of care, making the policy more expensive, but ensuring that benefits remain adequate as the cost of care increases over the years. A longer elimination period, option A, would generally lead to a lower premium because the insured will have to cover the initial period of care out of pocket before the policy begins paying benefits. Being young and in good health, option B, usually results in low premiums because the risk to the insurer is lower. Choosing a lower daily benefit amount, option D, would also typically reduce the cost of the premium as the policy would be paying less per day. Question 3. Scenario-based question, eligibility and underwriting. MS. Reynolds is 58 years old and considering purchasing a long-term care insurance etc. policy. She has a family history of Alzheimer's disease, but she has no symptoms herself and is in good health overall. After reviewing multiple options, she decides to go through medical underwriting to determine her eligibility. Given MS. Reynolds' situation, what would likely happen during the underwriting process? A. She will automatically be denied due to her family history of Alzheimer's. B. She will be required to undergo a cognitive screening as part of the underwriting process. C. She will be automatically approved because she currently has no symptoms of Alzheimer's. D. The insurer will skip medical underwriting entirely due to her age and offer her a policy based on general guidelines. Answer. B. She will be required to undergo a cognitive screening as part of the underwriting process. Explanation. During the underwriting process for long-term care insurance, it is common for insurers to require cognitive screenings, especially if the applicant has a family history of cognitive diseases like Alzheimer's. Option B. These screenings help assess the risk of the applicant developing such conditions even if they currently show no symptoms. Family history alone, option A, does not lead to an automatic denial, but it can influence the underwriting decision. MS. Reynolds would not be automatically approved, option C, just because she has no symptoms. Insurers evaluate many factors during underwriting. Additionally, skipping medical underwriting, option D, is highly unlikely as insurers need to assess individual health risks, especially at her age. In Utah, insurance regulations permit insurers to conduct detailed health and cognitive assessments to determine eligibility for LTCI policies, and cognitive testing is a critical part of assessing future risk for conditions that might require long-term care, such as Alzheimer's. Question 4. Federal laws and regulations. Under the Health Insurance Portability and Accountability Act HIPAA, which type of long-term care insurance policy qualifies for favorable tax treatment? A. A policy that covers cosmetic procedures. B. A policy that includes a return of premium feature. C. A qualified long-term care insurance policy that meets specific federal guidelines. D. A hybrid policy that primarily serves as life insurance with a small long-term care rider. Answer: C. A qualified long-term care insurance policy that meets specific federal guidelines. Explanation: under HIPAA, qualified long-term care insurance policies are eligible for favorable tax treatment if they meet federal standards. These policies allow premiums to be deducted as medical expenses, subject to certain limits, and benefits are generally not taxable as income as long as they do not exceed certain daily limits set by the IRS. Policies that cover cosmetic procedures (Option A) or include a return of premium feature (Option B) typically do not qualify for this favorable tax treatment, while hybrid policies (Option D) can sometimes offer long-term care benefits. Their primary focus as life insurance disqualifies them from the same favorable tax treatment as standalone qualified LTCI policies. Question 5. Benefits and claims process. Which of the following would most likely be a valid reason for a long-term care insurance claim to be denied? A. The insured failed to pay their premiums for the last 3 months. B. The insured is unable to perform one activity of daily living adult. C. The insured was diagnosed with Alzheimer's after the policy was in effect. D. The insured has a policy with a 60-day elimination period and has been receiving care for 45 days. Answer: A. The insured failed to pay their premiums for the last 3 months. Explanation: non-payment of premiums (Option A) is a common reason for claim denial. If the policyholder lapses on premium payments, their coverage can be terminated, making them ineligible for benefits even if they meet all other conditions for a claim. Failing to perform just one activity of daily living adult (Option B) is usually insufficient for a claim because most policies require that the insured be unable to perform 2 or more a DLS to qualify for benefits. Alzheimer's disease (Option C) is typically covered by LTCI policies provided the policy was in effect before the diagnosis. In the case of a 60-day elimination period (Option D), the insured must meet that waiting period before benefits begin, so a claim after 45 days would be denied until the elimination period is completed. Question 6. Utah State Regulations. What is required under Utah's standards for marketing long-term care insurance policies? A. Agents must provide consumers with a simple one-page summary of benefits only. B. Agents are required to use approved advertisements and avoid misleading marketing practices. C. Agents are allowed to make any comparisons between policies, even if incomplete, as long as they disclose they are partial. D. Agents are prohibited from discussing inflation protection during sales presentations. Answer: B. Agents are required to use approved advertisements and avoid misleading marketing practices. Explanation: in Utah, agents selling LTCI policies must adhere to strict standards for marketing, which include using state-approved advertisements and avoiding misleading marketing practices. Option B. These rules are in place to protect consumers and ensure that they are fully informed about the coverage they are purchasing. Providing only a one-page summary of benefits (Option A) would not be sufficient, as detailed and accurate disclosures are required. Making a complete comparisons (Option C) is not allowed because it can mislead consumers. Lastly, agents are required to discuss inflation protection options (Option D) during sales presentations, as this is a critical feature of LTCI policies. Question 7. Scenario-based question: eligibility and underwriting. Mr. Harris, a 62-year-old man, has been a smoker for 30 years but is otherwise in good health. He applies for a long-term care insurance policy and undergoes the underwriting process. His medical records indicate a history of respiratory issues but no major illnesses. He is concerned about his chances of being approved for coverage. Based on Mr. Harris' history, what is the most likely outcome of the underwriting process? A. Mr. Harris will automatically be approved due to his age and overall health. B. Mr. Harris may face higher premiums or be subject to certain exclusions due to his smoking history. C. Mr. Harris will be denied coverage solely because of his smoking history. D. Mr. Harris will receive a policy with no adjustments since smoking is not a concern for LTCI policies. Answer: B. Mr. Harris may face higher premiums or be subject to certain exclusions due to his smoking history. Explanation: Mr. Harris is likely to face higher premiums or policy exclusions due to his smoking history. Option B. Smoking is a significant risk factor for many health conditions, and insurers often adjust premiums or impose exclusions on individuals with a long history of smoking. Is age. Option A. And otherwise good health may work in his favor, but smoking increases the likelihood of long-term health issues, which affects the underwriting decision. Smoking alone is generally not enough to deny coverage. Option C. But it can result in higher costs or restricted coverage. Smoking is a concern for LTCI policies. Option D, as it increases the risk of developing health conditions that could lead to long-term care needs. Question 8. Ethical considerations and standards of practice. Which of the following would be considered unethical behavior for an agent selling a long-term care insurance policy? A. Explaining the cost of inflation protection to a client during a policy review. B. Advising a client to purchase a policy that the agent knows is not affordable for them. C. Offering clients options for long-term care policies from multiple insurance companies. D. Discussing both the advantages and limitations of a specific long-term care policy with the client. Answer. B. Advising a client to purchase a policy that the agent knows is not affordable for them. Explanation. It would be unethical for an agent to advise a client to purchase a policy that they know the client cannot afford. Option B. Agents have a duty to act in the best interest of their clients, ensuring that they are selling policies that are appropriate for the client's financial situation and needs. Discussing the cost of inflation protection. Option A. Offering a range of policy options. Option C. And providing a full review of a policy's advantages and limitations. Option D. Are all ethical and responsible actions that help the client make an informed decision. The UTO Insurance Code and National Association of Insurance Commissioners (NAIC) model regulations set standards for ethical behavior, including the duty to recommend policies that are suitable for the client's circumstances. Question 9. Long-term care planning. When evaluating long-term care insurance as part of a comprehensive financial plan, what should clients be advised to consider? A. The client's age, health status, and potential future medical needs. B. Only the current cost of care without accounting for future inflation. C. Whether their life insurance policy offers any long-term care riders. D. The likelihood of qualifying for Medicaid within the next 5 years. Answer A. The client's age, health status, and potential future medical needs. Explanation. When planning for long-term care, clients should consider factors such as their age, health status, and potential future medical needs. Option A. These factors affect the likelihood of needing long-term care and the potential costs they may face. Relying solely on the current cost of care. Option B can be risky, as future inflation can dramatically increase the cost of long-term care services. While some life insurance policies offer long-term care riders. Option C, these may not provide comprehensive coverage for all long-term care needs. Finally, Medicaid eligibility. Option D is limited, and many clients may not qualify for Medicaid benefits unless they meet strict asset and income requirements, making long-term care insurance a more suitable option for many individuals. Question 10. UTO state regulations. Which of the following is not a requirement under UTO's licensing standards for long-term care insurance (LTCI) agents? A. Agents must complete a specific number of continuing education hours focused on long-term care insurance. B. Agents must provide full disclosure of policy limitations during the sales process. C. Agents must pass a state-administered exam specific to long-term care insurance policies. D. Agents must adhere to the client's specific request even if it results in a policy that may not suit their financial situation. Answer. D. Agents must adhere to the client's specific request even if it results in a policy that may not suit their financial situation. Explanation. Under UTO law, agents are required to act in the best interest of the client and provide policies that are suitable for the client's needs and financial situation. Option D suggests agents must follow the client's request even if it's not in their best interest, which would be unethical and in violation of both UTO Insurance Code and NAIC regulations. Continuing education, Option A, full disclosure, Option B, and passing a state exam, Option C, are all essential requirements for maintaining an LTCI license in UTO. Question 11. Policy provisions and features. Which of the following is the best definition of a benefit trigger in long-term care insurance? A. The time period after a claim is filed before benefits start. B. The event or condition that qualifies an insured to start receiving benefits. C. A clause in the policy that defines which benefits are payable. D. The annual increase in benefits to keep pace with inflation. Answer. B. The event or condition that qualifies an insured to start receiving benefits. Explanation. A benefit trigger, option B, is a specific event or condition that must occur before an individual can start receiving long-term care insurance benefits. This often includes the inability to perform two or more activities of daily living adults, such as bathing or dressing, or a diagnosis of cognitive impairment. The elimination period, option A, is the waiting period before benefits start, and option C refers to policy provisions defining which benefits are payable, while option D refers to inflation protection. Question 12. Eligibility and underwriting. Which of the following medical conditions is most likely to impact an applicant's eligibility for long-term care insurance? A. High blood pressure controlled by medication. B. A family history of heart disease. C. A diagnosis of Alzheimer's disease. D. A history of seasonal allergies. Answer. C. A diagnosis of Alzheimer's disease. Explanation. A diagnosis of Alzheimer's disease, option C, would significantly impact an applicant's eligibility for long-term care insurance, as it indicates a high likelihood of needing long-term care. Insurers may deny coverage or charge significantly higher premiums due to the increased risk of claims. High blood pressure, option A, and a family history of heart disease, option B, may be considered during underwriting but are often manageable risks. Seasonal allergies, option D, have little to no impact on underwriting for LTCI. Question 13. Scenario-based question. Benefits and claims process. Mrs. Thompson, a 75-year-old policyholder, has been receiving care in an assisted living facility for 2 months. Her long-term care insurance policy has a 90-day elimination period. She is concerned that she won't receive any benefits for her care. The facility costs $200 per day, and she has already paid $12,000 out of pocket. Which of the following is most accurate regarding Mrs. Thompson's claim situation? A. She will receive benefits immediately, as she has already paid $12,000. B. She must wait until the 90-day elimination period ends and benefits will then begin. C. She will be reimbursed for the $12,000 after the elimination period ends. D. She will only receive benefits if her care continues for more than 6 months. Answer. B. She must wait until the 90-day elimination period ends and benefits will then begin. Explanation. Mrs. Thompson must wait until the 90-day elimination period, option B, has passed before her benefits begin. The elimination period is a waiting period during which the policyholder is responsible for paying the cost of care. It functions similarly to a deductible in health insurance. The $12,000 she has already paid will not be reimbursed, option C, as the elimination period must be met first. The duration of care, option D, does not affect the elimination period unless otherwise stated in the policy. Question 14. Consumer considerations. When advising a client on purchasing long-term care insurance, which factors should be given the most weight? A. The client's ability to qualify for Medicaid in the near future. B. The affordability of premiums based on the client's long-term financial plan. C. The client's short-term health and recent medical procedures. D. The size of the benefit pool compared to the cost of a nursing home in the client's area. Answer. B. The affordability of premiums based on the client's long-term financial plan. Explanation. The affordability of premiums, option B, in relation to the client's long-term financial plan is a critical factor when advising on long-term care insurance. Clients need to ensure that they can continue paying premiums over the long term, as failing to do so could result in policy termination and loss of coverage when it's needed most. While the size of the benefit pool, option D, is important, it must align with the client's budget. Short-term health, option C, is less important unless it affects underwriting. Relying on Medicaid, option A, may not be viable for many clients, as Medicaid typically requires the depletion of assets. Question 15. Long-term care planning. Which of the following strategies is most appropriate for long-term care planning in early retirement? A. Relying entirely on Medicare for long-term care needs. B. Purchasing a hybrid life insurance or long-term care policy. C. Setting aside a portion of retirement savings to pay for long-term care. D. Delaying the purchase of long-term care insurance until age 75. Answer. B. Purchasing a hybrid life insurance or long-term care policy. Explanation. For early retirees, a hybrid life insurance or long-term care policy, option B, can be a suitable option. These policies combine life insurance benefits with long-term care coverage, providing flexibility and coverage for future long-term care needs without losing the value of premiums paid if care is never needed. Medicare, option A, provides only limited coverage for long-term care, primarily for short-term rehabilitative stays. Self-funding, option C, could be risky as long-term care costs can deplete savings. Delaying the purchase of LTCI, option D, until age 75 often leads to much higher premiums or denial due to health issues. Question 16. Policy provisions and features. Which of the following is most likely to increase the cost of a long-term care insurance policy? A. A short elimination period. B. A low benefit amount per day. C. Fewer covered services. D. A longer waiting period for inflation protection to apply. Answer A. A short elimination period. Explanation. A short elimination period, option A, increases the cost of a long-term care insurance policy because the insurer begins paying benefits sooner. The elimination period is like a deductible period where the policyholder covers costs out of pocket before benefits start. Low benefit amounts, option B, and fewer covered services, option C, typically result in lower premiums. A longer waiting period before inflation protection applies, option D, can reduce costs as the benefits won't increase as rapidly. Question 17. Ethical considerations and standards of practice. Which action would be considered unethical for a long-term care insurance agent in Utah? A. Recommending a policy based on the client's stated needs. B. Making policy comparisons that exclude key features to make one policy appear superior. C. Providing clients with a detailed explanation of the inflation protection options. D. Discussing long-term care needs and planning for care with the client's family present. Answer. B. Making policy comparisons that exclude key features to make one policy appear superior. Explanation. It would be unethical for an agent to make comparisons that deliberately exclude key features, option B, to mislead a client into thinking one policy is better than another. Under the NAIC Model Act and Utah's ethical guidelines, agents must provide accurate and comprehensive information to help clients make informed decisions. Recommending a policy based on needs, option A, explaining inflation protection, option C, and discussing care with the family, option D, are all ethical practices that align with the agent's duty to inform and advise clients responsibly. Question 18. Waiver of premium. What is the purpose of a waiver of premium provision in a long-term care insurance policy? A. It allows the insured to skip paying premiums if they stop using care services. B. It suspends premium payments once the insured starts receiving long-term care benefits. C. It permanently reduces the policy's premiums based on financial hardship. D. It allows the insured to adjust their coverage without changing premiums. Answer. B. It suspends premium payments once the insured starts receiving long-term care benefits. Explanation. The waiver of premium provision, option B, suspends the requirement to pay premiums once the insured starts receiving long-term care benefits. This helps reduce the financial burden during a time when the insured may already be facing significant care costs. Option A is incorrect because the provision is typically tied to benefit receipt, not care usage. Options C and D misrepresent the waiver of premiums function as it does not involve reducing premiums or adjusting coverage. Question 19. Utah State Regulations. Inflation protection. What is the primary purpose of the inflation protection feature in a long-term care insurance policy? A. To increase the elimination period based on market trends. B. To adjust the policy's premiums according to inflation rates. C. To ensure that benefit amounts increase to keep up with rising care costs. D. To reduce the overall cost of the policy by excluding inflation adjustments. Answer. C. To ensure that benefit amounts increase to keep up with rising care costs. Explanation. The inflation protection feature, option C, is designed to automatically increase the policy's benefit amounts over time to account for the rising costs of long-term care. This helps policyholders maintain sufficient coverage even as care costs inflate. Options A, B, and D misrepresent how inflation protection works. It primarily impacts the benefits, not the elimination period or premiums, and its purpose is to enhance coverage, not reduce costs. Question 20. Long-term care insurance. Spousal discounts. Which of the following is a common benefit offered to married couples or partners who both purchase long-term care insurance? A. Increased premium rates to account for potential joint care needs. B. An automatic waiver of the elimination period for both partners. C. A spousal discount that reduces premiums for both partners. D. A joint policy that guarantees lifetime benefits for both individuals. Answer: C. A spousal discount that reduces premiums for both partners. Explanation: many long-term care insurance providers offer a spousal discount, option C, which reduces the premiums when both spouses or partners purchase coverage. This incentive is designed to encourage both partners to secure long-term care insurance, reducing the cost of coverage. Increased premium rates, option A, are incorrect as joint applications typically low rates. There's no automatic elimination period waiver, option B, and joint policies with guaranteed lifetime benefits, option D, are uncommon. Question 21. UTOR's Partnership Program. Under UTOR's Long-Term Care Partnership Program, what is the primary advantage of purchasing a partnership policy? A. The policyholder can access Medicare benefits for long-term care. B. The policyholder can protect a portion of their assets if they need Medicaid assistance. C. The policyholder receives a tax deduction for long-term care premiums. D. The policyholder is automatically eligible for home care services. Answer: B. The policyholder can protect a portion of their assets if they need Medicaid assistance. Explanation: the UTOR Long-Term Care Partnership Program allows policyholders to protect a portion of their assets if they deplete their long-term care insurance benefits and need to apply for Medicaid. Option B. This asset disregard feature makes it easier for policyholders to qualify for Medicaid while retaining some of their assets. The program doesn't provide direct Medicare benefits, option A, or guarantee home care services, option D. Tax deductions, option C, may apply but are not the primary benefit. Question 22. Types of care covered by long-term care insurance. Which of the following types of care is least likely to be covered by a standard long-term care insurance policy? A. Assisted living facility care. B. Custodial care in a nursing home. C. Skilled nursing care. D. Experimental medical treatments. Answer: D. Experimental medical treatments. Explanation: experimental medical treatments, option D, are typically excluded from standard long-term care insurance policies as they fall outside the scope of traditional care services. Long-term care policies usually cover custodial care, option B, skilled nursing care, option C, and care in assisted living facilities, option A, but experimental treatments are not generally covered due to their uncertain outcomes and costs. Question 23. Claim denials and appeals. If a claim for long-term care insurance benefits is denied, which of the following actions is the first step? The insured should take file a lawsuit against the insurance company. B. File a formal complaint with the state insurance department. C. Review the policy and request a written explanation from the insurer. D. Immediately stop paying premiums to protest the denial. Answer: C. Review the policy and request a written explanation from the insurer. Explanation: the first step in addressing a claim denial is to review the policy and request a written explanation from the insurance company. Option C. This allows the insured to understand the specific reasons for the denial and determine if the claim was denied based on valid policy provisions. Filing a lawsuit, option A, or a complaint, option B, may be necessary later, but these actions should follow after understanding the denial. Stopping premium payments, option D, could lead to a policy lapse, which is counterproductive. Question 24. Home care services coverage. Which of the following conditions must typically be met for a long-term care insurance policy to pay for home care services? A. The policyholder must be unable to perform at least 2 activities of daily living adults. B. The policyholder must have been hospitalized for at least 60 days prior to requiring home care. C. The policyholder must use home care services exclusively for custodial care. D. The policyholder must reach the age of 75 to qualify for home care services. Answer A. The policyholder must be unable to perform at least 2 activities of daily living adults. Explanation: most long-term care insurance policies require that the policyholder is unable to perform at least 2 activities of daily living adults. Option A. To qualify for home care services, these DLS often include tasks such as bathing, dressing, and feeding oneself. Hospitalization, option B. Custodial care, option C. And age thresholds, option D, are not common requirements for home care coverage, which is typically based on functional impairments. Question 25. Premium increases. Which of the following is most likely to lead to an increase in premiums for long-term care insurance after the policy is issued? A. A significant decline in the insured's health. B. The insured electing to reduce the elimination period. C. The insured filing multiple claims for long-term care services. D. A general rate increase approved by the state insurance department. Answer: D. A general rate increase approved by the state insurance department. Explanation: premiums for long-term care insurance can increase due to general rate increases, option D, that are approved by the state insurance department. These increases typically affect all policyholders within a specific class and are not tied to individual health changes, option A, or claims, option C. Electing to reduce the elimination period, option B, might increase premiums if it's an option, but it would involve a policyholder request rather than a unilateral increase by the insurer. Question 26. Elimination periods. In long-term care insurance, the elimination period refers to A. the time during which the policyholder is required to pay for services before benefits begin, B. the period during which premiums are waived once the insured starts receiving benefits, C. the maximum time the insured can receive benefits before the policy is terminated, D. the time frame in which the insurer can cancel the policy for non-payment of premiums. Answer A. The time during which the policyholder is required to pay for services before benefits begin. Explanation: the elimination period, option A, is the waiting period between when care begins and when the policy starts paying benefits. It functions similarly to a deductible, but in terms of time, during this period, the policyholder must cover the costs of care out of pocket. Options B, C, and D describe other features like premium waivers, maximum benefit periods, and policy cancellations, which are unrelated to the elimination period. Question 27. Long-term care insurance riders. Which of the following is a common rider that can be added to a long-term care insurance policy to enhance its coverage? A. A return of premium rider that reimburses unused premiums. B. A pre-existing condition rider that excludes coverage for certain health issues. C. A lifetime benefit rider that eliminates the total benefit limit. D. An automatic renewal rider that guarantees the policy can never be cancelled. Answer A. A return of premium rider that reimburses unused premiums. Explanation: the return of premium rider, option A, is a common option that can be added to a long-term care insurance policy. It reimburses the policyholder or their estate for unused premiums if the policyholder never needs long-term care or dies before benefits are paid. Question 20. Tax treatment of long-term care insurance premiums. Under current federal tax law, how are long-term care insurance premiums treated for tax purposes? A. They are fully tax deductible regardless of the policyholder's income. B. They are tax deductible up to a certain limit based on the policyholder's age. C. They are considered taxable income. D. They are only deductible if the policyholder receives benefits from the policy. Answer B. They are tax deductible up to a certain limit based on the policyholder's age. Explanation: long-term care insurance premiums are tax deductible, option B, under federal tax law, but the amount is limited based on the policyholder's age. The older the policyholder, the higher the allowable deduction subject to IRS guidelines. Premiums are not fully deductible, option A, and they are not considered taxable income, option C. Receiving benefits, option D, does not determine deductibility. Question 29. Benefit triggers. Which of the following conditions is a common benefit trigger for long-term care insurance? A. The insured requires assistance with at least 2 activities of daily living adults. B. The insured has been diagnosed with a terminal illness. C. The insured reaches the age of 65. D. The insured has an annual income below a specific threshold. Answer A. The insured requires assistance with at least 2 activities of daily living adults. Explanation: a common benefit trigger, option A, for long-term care insurance is the need for assistance with at least 2 activities of daily living adults, such as bathing, dressing, or eating. This condition activates the policy's benefits. Diagnosed as a terminal illness, option B, age, option C, or income, option D, are not standard benefit triggers for long-term care insurance policies. Question 30. Comprehensive coverage. What does a comprehensive long-term care insurance policy typically cover? A. Only care received in a nursing home. B. Both nursing home care and home care services. C. Only care received in the policyholder's home. D. Care received in any facility without limitation. Answer B. Both nursing home care and home care services. Explanation: a comprehensive long-term care insurance policy, option B, covers both nursing home care and home care services, providing flexibility for where the policyholder receives care. These policies are designed to offer a broader range of services than those that only cover care in specific locations like nursing homes option A or home option C. Option D is incorrect, as even comprehensive policies may have some limitations on the types of facilities covered.